All right, guys, welcome back. This is class number 3, how to find trades. All right, so you guys understand what swing trading is, why it's significant, why it could be the best strategy for you, how to buy into a specific particular stock, what to look for, how to do the technical analysis, chart reading, chart patterns, candlestick patterns, technical indicators, all these different things. Now, how do I use that information and apply that to an actual stock and get some money? That's what we're going to find out today. So how do you find trades? How do you find trades? Step-by-step process. First, you need to understand that scanning for trades is something that you must learn how to do, because it's not enough for you to just watch the news or just get tips and tricks or whatever from other people that you might see or interact with on a day-to-day basis. Just driving down the street and looking at different brands and buildings that might be publicly traded. That's not enough. Those things can help give you a sense of awareness, but it's not going to get you to the point to where you're jumping into companies that are at a point to where you can react to them quickly, right? So you might be driving down the street and you pass a Walmart, and at that moment you say, "Oh man, maybe I should pull up Walmart on the chart and look it up to see if I want to buy it." You can do that, but at times that might be a waste of your time, because Walmart might not even be close to a point where you need to be buying it at. Rather than do that, you could use some of these strategies that I'm about to go and give to you to point you in the right direction, to where you can filter out all the noise and get directly to the companies that fit into the criteria that you want to meet in order for you to even look to decide if you want to jump in or not. All right. So here's a quote by Howard Marks: "Superior investing doesn't come from buying high quality assets, but from buying when the deal is good, the price is low, the potential return is substantial, and the risk is limited." That's exactly what we want to do. And that's exactly what we're learning how to do with this course. All right. So understand that there's 11 sectors in the market. There's 11 different sectors in the market. All right. A quick way for you to get through all that and understand exactly what sectors we're looking into. You can go to a website like ETF.com. Excuse me. You can go to the website like ETF.com. All right. And ETF.com will show you everything you need to see in order for you to find the sectors that you're looking for and find the stocks within that particular sector you're looking for. All right. So just real quick, we're looking for sectors. All right. So here you can see a few here, but we want to get direct and find the ones that we are searching for. So screener, database, all right. And then you have the sectors here. So you have basic materials, consumer cyclical, consumer non-cyclical, energy, financial, healthcare, industrial, real estate, tech, telecom, utilities. These are the 11 sectors on the stock market. All right. You need to understand that at all times. This is going to help you narrow down what you're looking at, because there's thousands of stocks on the market and there's new publicly listed companies that are IPOing every day. In order for you not to get confused and to get overwhelmed and bombarded by a whole bunch of different stocks, you need to focus on certain sectors at a time and understand that each sector has a cycle where there's going to be times where it's bullish, there's going to be times where it's bearish, there's going to be times where it's moving sideways. Through that cycle, you need to find the ones that are in the that are ready for a bullish breakout or already in a bullish trend, and trade those while the other ones get a reset, and then you rotate. All right. So when we're talking about portfolio allocation or asset allocation and portfolio management, we speak about balancing your portfolio and making sure you have a good enough amount in each sector spread out to where if one sector is doing bad, it's not going to take down your whole portfolio. It'll be balanced enough to where if one sector is doing bad, another sector is doing good, you kind of even out. It's not detriment to your whole overall portfolio because you're spread out and you have a little bit in each sector, or at least the ones that are the most profitable at that particular time. All right, so very often you'll hear the term sector rotation. That's a common theme in the investing community, where people understand that sectors have their rotations. Through COVID, you've seen a rotation between growth stocks and value stocks, for instance. Value stocks are companies that have been around for a very long time, very valuable companies that have a long track record. Let's say, for instance, a company like Coca-Cola has been around for decades. And because they've been around for so long, their company is more stable than others. And because they're more stable than others, they happen to be more profitable than others. And with that profit, there's an incentive for you to invest in that particular company, and they happen to pay dividends to their investors, which is cash flow, right? So when you have a situation like that, normally you're only going to have that type of situation with value companies. On the other hand, you have companies that are in the growth stage, right? So relatively new companies that have been publicly listed on the market for a few years, that only thing they're worried about is growing the company at this particular point. So they cannot afford to divvy out their profits to their investors as of yet. They need those profits to stay in the company so that they can reinvest and grow and get to the point to where they're on a level like a Coca-Cola, right? So growth companies might give you a huge amount of profit because they have the potential to have huge spikes in any given moment and a large amount of volume at any given moment, large amount of volatility at any given moment. That might be promising for some, but that right there is not stable enough for you to only depend on growth companies in your portfolio. You want to have a balance, and particularly for me, you want to have more in value and less in growth. Growth, more money that you want to play around with, and not necessarily look to get a huge amount of return. But if you do get a huge amount of return, it's a great bonus. That's play around money, because it could go either way. It could be volatile bullish, volatile bearish. It could give you both ways, right? Not to say that value companies can't either, but remember, the stock market is designed for stock companies to rise in value. And with valuable companies, you'll see that if you go back 5, 10, 15, 20 years prior, the stock price is probably way less then than it is right now. And that's essentially what you want to be in. That's where your money needs to be, all right? So tech companies, a lot of times in today's age, have more growth companies in them, newer companies, right? More exciting companies, trending companies, companies that the younger generations are a little bit more familiar with, and they're relatively new companies that need to continue to grow, which is a growth stock. Valuable companies like a Walgreens Boots Alliance that we looked at yesterday in the previous class, Coca-Cola, the example that I just gave, or even the McDonald's company has been around since way back. Those are value companies. All right, so know the difference between the two. All right, so these are the 11 sectors, and you need this information, and you use this information to help you find trades. Now, the next step in this particular situation here, you want to look for the bullish sectors for long positions and the bear sectors for short positions, looking to see which ones are bullish and bearish. Now, this chart right here gives you everything you need to see. All right, so the red obviously is bearish and the green obviously is bullish. And if we're looking at what we're looking at right now, you can see that the consumer cyclical is bullish. Consumer discretionary or non-cyclical is bullish. All right, energy is bearish, materials bearish, financials bearish, healthcare is bearish, industrial is bearish, real estate's bullish, tech is bearish, telecoms bearish, utilities bearish. This is just for today. All right, so for today, this is what we're working with. This is the information we're working with. Now, let's say, for instance, you wake up in the morning and you're waiting for the market to open up. It's 9:30, 9:40, market's open. You pull this up and you look and see which sectors are green, which sectors are red. How do you move forward with this information? If I were to take this information right here, The next step I would do is I would say, okay, consumer cyclicals are bullish, right? I would click on consumer cyclical and look at this particular ETF. This ETF right here, XLY, is an exchange traded fund that contains a large amount of companies that are in that sector. So what that means is the companies that are contained inside of this ETF, if they're moving one way, then the overall ETF will be moving in that direction as well. So if we look at this and we say that the XLY ETF is bullish, then you can pretty much guarantee that the stocks inside of that ETF are also bullish. So what we do is we pull up the XLY ETF and we go and look and see what companies are contained inside of this particular fund, right? So we can scroll down and look and see top 10 holdings, right? And we want to view all of them. So you got Amazon here, you got Tesla, Home Depot, Nike, McDonald's, Lowe's, Starbucks, Target, Booking Holdings, TJ Maxx, TJX, General Motors, Chipotle, Dollar General, Ford, eBay, Ross, O'Reilly, so on, so on, so on, right? And then you also can see on the side, holding allocation. Basically what that means is what percentage of the overall fund is representative of that particular company. So Dollar General, for instance, Dollar General is 1.36% of the actual fund. So that's not to say that Dollar General is a huge amount of, or this fund has a huge amount of Dollar General stocks. It's only 1.36% of the overall fund. So keep that in mind when you're looking at the direction of the actual fund. So let's say the fund takes off and it's straight bullish, right? But then you pull up the Dollar General stock and the Dollar General stock isn't really going anywhere. Just understand that it's only 1.36% of the overall fund. So that might not give you a good representation of where that particular stock might be because it's only 1.36% of that fund. But if you compare that to Amazon, where Amazon is 22.25% of that actual fund, if the fund is bullish, you can pretty much guarantee that Amazon is bullish for the day. All right. So that's what we're talking about. So let's just pull up Amazon, for instance, right? So if we pull up Amazon, Amazon's bullish, right? So the market is closed now. So now, you know, we're looking at post-market movement and all that, but the market is closed. But for the day, Amazon was bullish, right? So that would have been how you found out what to look at. So you don't have to necessarily pull up 100 different stocks every single morning and look at this, and look at this, and look at this. That takes too much time. Quick way to do it, pull up ETF.com, look at this 11 sectors, find out which one's green, which ones are red, go inside of the sector and look at each individual holding in that sector or in that ETF, pull that up on your chart and then look for entry. All right, that would be a quick way to find or at least start, right? So setup, very, very important. Me personally, I don't trade anything if I can't find a setup. What is a setup? We just talked about candlestick charts. Candlestick patterns are setups, right? Now we're talking about chart patterns, right? I'll have a chart pattern course, a chart pattern cheat sheet course that's available for you to look at and study so that you can understand certain chart patterns that you need to be aware of that will help you increase your win rate, right? So if I'm telling you that I only trade setups, basically what that means is I'm minimizing my loss and minimizing my risk by only trading setups that are going to give me the same outcome every single time. So if I'm a bullish trend trader, I'm looking for bullish setups. I'm looking for bullish candlestick patterns or bullish candlestick reversal patterns. And I'm looking for bullish chart pattern setups. If I don't see them, I don't trade anything. That's my way of protecting myself, protecting my money, and making sure that I get the most bang for my buck in this market. So as far as chart patterns, let's see if we can find one on Amazon. All right. So you see this right here, and you know, the last one you saw was blue. This one is green. All right. Every now and then I go and change up the settings on my charts just to stay fresh. Visually, sometimes you need something to look at that's a little new. so this game doesn't become too boring. And obviously making money is never boring, but looking at this chart and examining all these different patterns and just stocks in general. I also have a VIP membership available for any of y'all who are interested. We have a group of individuals, over 200 people in there, who constantly asking questions, constantly getting guidance. We have a group meeting through Zoom every single Sunday at 7 p.m. Eastern time. All the VIP members are there, constantly asking questions and getting clarity, getting an understanding, and we're still learning. We're still sharpening up our skills, and we're getting ready for the week ahead. We're making money all week. So with that, I have to look at hundreds of stocks throughout the week. Sometimes constantly looking at the same chart over and over again. You need to change things up. So I might have a black background one day. I might have a white background one day. I might have, different colors on my moving averages or different colors on my RSI. I might have my position tool looking different. That right there is something that, everybody will have the ability to do with TradingView. It makes it easy. All right, so let's see. Now, we saw that I got into this position here. Obviously, I hit my target. I made my profit, 7.72% return, swing high to swing low, got out at the overbought RSI position here at 70, cashed out, perfect swing trade, no problem, easy money, right? But why did I even get into this position in the first place? I got into this position because I saw a chart pattern. So now, if we go back in time and look at before I got into this particular position, you can see what's going on with Amazon stock, right? First thing we always want to do is locate support and resistance, right? So if we pull this up, I don't know why this keeps popping up. If we pull this up, we look at setups, moving average for direction, moving averages for direction. In the last class, we said 50, 200, the 50 moving average and the 200 moving average relationship will let us know if we're on the right side of the market or not, right? And also the 20 moving average can also be used as somewhat of an entry tool to help us get into a particular stock, right? Support and resistance, very important. Sometimes we find support and resistance with the moving averages. Sometimes we find support and resistance using the trend lines and other different tools that we might put on our chart, right? Moving average breakouts, like I said, the 20 moving average the price crossing over the 20 moving average, helping us get into a trade, or price crossing over the 200 or the 50, however we decide to play it. And then we also have analyst price forecasts, right? So we can see where the forecast is for the year, right? So let's check that out. Now, a tool that I like to use for price forecast is TipRanks, and I also like to use Yahoo Finance. So if we look at TipRanks and we look at Amazon, for instance, type in Amazon, and you can see that the analysts say strong buy. You have 30 ratings, so 30 analysts have rated strong buy. Not a single analyst on here told you to sell or hold. Everybody's telling you to buy Amazon stock, strong buy. The price forecast for this is $4,214.13. What that means is all 30 of these analysts think that by the end of this year, Amazon's price should be at or around $4,214.13. From the point that it's at right now today, that's a 21.42% price increase from where it's at right now. So basically what they're saying is if you were to buy Amazon right now, you can look to gain a potential 21.42% in the price if it reaches its target for the year. Right now, it's trading at $3,470.79. Right? We're going back in the time though. So if we're looking at the chart right now, it's at $3,222.90. Right? But we're just trying to figure out, why did I jump into this trade? What did I look at, and what made me do this? Right? So first thing I want to do is find support and resistance. What are we looking at? Higher highs, higher lows. Do we see any? Are we in an upward trend? Right? Here's a low point. Here's a low point. Here's a low point. Here's a low point. Higher lows. Right? Where are the high points? High point, high point, high point, high point, high point, higher highs. So we got higher highs and we got higher lows. We're clearly in an uptrend. Right? I can take this and I can use the trend line tool and try to connect the low point to this low point and drag it out. Right? Or I could take this into the equation as well and drag it out here. Either way, I wouldn't be wrong. So there's my trend line, letting me know that price does not want to go below this trend line right here. That's my support level. Now, do I need to find a resistance level? Sometimes you do, sometimes you don't, depending on how you want to use this. If you want to use a trend line, you can take the trend line here and drag it out up there, or you could go back in time and use this high point back here, right, as a potential trend, as a potential resistance level, because you see that the price, and sometimes I like to use the rectangle, the price touched here, and it touched here again, and then it touched here again, and then it stopped here again and broke the trend, broke the line and went up and came back down. So I could drag this out because that right there is data that I need to be aware of. So this right here is a point where price reversed on me. Right here, it reversed on me. Right here, it reversed on me. Right here, it had trouble getting up. So one day it was red and it paused right here in this price range. That right there is letting me know that this price range is very, very important. So I have to notate that. That is a resistance level that I have to notate. All right. So now I got support and I got resistance, and I drag them out to where they connect to each other. Looks like a triangle, right? That's a chart pattern. So this is what I'm talking about with setups, right? So maybe I didn't find a bullish engulfing candle. Maybe I didn't find a bearish harami or a bullish harami or evening star or a doji. Maybe I didn't find all these different candlestick chart terms and all that. Maybe I just looked at what I'm seeing right now, which is market structure, support and resistance, trend line up, resistance line across, letting me know where I'm at. That right there is a setup. Now I can do one or two things with this information. I can take this information and try to trade it now by using the information here that I have with the support level, knowing that the stock price doesn't want to go below, trading it all the way up to the previous high, or trade it all the way up to the previous resistance level, anticipating the price actually hitting this resistance level and potentially dropping again like it did back here or here. Or I can just wait until this whole sequence plays out and trade it when it gets closer to the end, where it should break out into the bullish direction. And with the chart pattern cheat sheet course, I actually give you a cheat sheet with all these different patterns on them to where you can see what direction the stock is going to go if you can spot the actual pattern. So this pattern will be on that cheat sheet, and the answer to the pattern will be on that cheat sheet as well. You see a pattern like this, you know that it's going to break out in a bullish direction. So like I said, you could either take this information and trade it now, or you could wait until it actually breaks out of this pattern in the direction that the cheat sheet tells you it's going to go and trade it then. Either way, it's up to you. So now we got that, right? Let's see what the moving averages are telling us. Let's look at the 200 and the 50-day moving average relationship. Are we in a buyer's market or a seller's market? You see the 50 moving average is actually just crossed above the 200. So that's letting us know that we're in a bullish market. And not only that, but the candlestick for the day is telling you that it actually wants to go above the 50 to make it a legit bullish market. My question to myself is, at what point do I want to buy in? Do I want to wait until the 50 moving average gets crossed? Or do I want to jump in now, anticipating that it's going to cross it and just try to get it in at the best price, right? Let's see what the 20-day moving average is doing. We pull up the 20-day moving average. You see that the 20-day moving average is all the way up here. So if I was using the 20-day moving average as an entry point, I would have to wait because the 20-day moving average is so far away from price, it doesn't make sense for me to jump in at this particular point if that is my trigger. You get what I'm saying? So let's see what happens when we play this out. Now, remember, the price target for Amazon is all the way up in the 4,000s. Right now, we operating in the 322. So that could be another target. If you want to go off of what the analysts say, you could pull your target all the way up to where the analysts say it's going to go and potentially get a 29.36% gain, but you have to anticipate holding it for the rest of the year because the forecast is based on the year, not where we're at right now. Forecast is the yearly forecast. So by December, basically, somewhere in between January and December, we think that this price is going to get all the way up to here or maybe go beyond. Usually it will go beyond, right? So that choice is yours. All right, so now we put all that together. We see the chart pattern, we see the candlesticks, we see the moving averages, we see support, we see resistance, we see everything we need to see. What else can we pull together to see if we should jump into this? Follow the money. So following the money, this right here website is called Datarama. This is what I use to help me see and keep track of what these super investors are doing. And the super investors would be market makers, hedge fund managers, portfolio management, people who manage millions and billions of dollars on a day-to-day basis. What stocks are they into? What stocks are they selling? What stocks are they buying? This is the information that I use to examine all of that, right? So we can look at the activity and see when the top 10 buys and sells are, right? And if I see Amazon in here somewhere and I see somebody that is managing billions of dollars selling Amazon, that might raise an eyebrow and make me want to go do some further research to see if I can find some fundamentals and figure out as why they decided to sell all their Amazon or sell a little bit of their Amazon stocks, right? And obviously this is Q2. So this is delayed information for the most part, but it still helps overall big picture, right? So real-time data here, you can see August 27th, which is 2 or 3 days ago, right? Transaction date, August 27th. You see Trian Fund Management LP sold Wendy's. They sold 382,000 shares of Wendy's, right? So they cashed out on $8.9 million by selling their Wendy's stock. Or really, they did it a few times. So they really cashed out about $11 million by selling all their Wendy's shares. All right. If you've seen that and you're looking to take a position on Wendy's, maybe that might make you second guess it because you always want to stay on pace with the money. Remember, the stock market is going to move with the money. So if the people who have millions and billions of dollars are buying into a specific stock, what's going to happen to that stock price? The stock price is going to go up. You want to go where the money's going. So if the money is leaving this particular stock, you definitely don't be the only one jumping into it and buying it, because that just means that you're going to just give your money away by the stock market decreasing in value. You know what I'm saying? And you can see that they've been selling Wendy's all month. This particular fund has been selling Wendy's all month. So now you got to look at Wendy's stock and see if this movement right here had an actual effect on the stock price. Let me go on a tangent and find out. Wendy's. And I'm just curious, you know. All right, so you can see that, what is this? August 18th. Since August 18th, the price has been dropping. Now that doesn't mean that one particular fund selling Wendy's stock is the reason why the stock price is dropping, but it definitely is playing a part in it. And you can see that the trend is actually dropping. The MACDs has been triggered, the RSI is below 50, and you got a dividend day coming here, so which that could make the stock go up a little bit periodically, but the overall trend is definitely bearish, all right? And you can see this huge bearish movement back here starting in June. All right. So let's go back to what we was looking at before. Amazon. So now we all the way back to where why did I jump into Amazon and what made me so confident to get in at that particular time? Chart pattern, moving averages, all that, right? Let's see if we don't want to get too far ahead. Let's make sure we, okay, great. So now let's play this out and see, you know, what happened. Obviously we know what happened, but why did I jump in at that particular time? What made me jump in at that particular time? So you see, I jumped in on May 17th. The reason why I jumped in May 17th, clearly because the 50 moving average was crossed as well as the 200 moving average. Both of the moving averages got crossed. And then because I didn't wait until the 20 got crossed, you saw how the 20 moving average and the price rejected the 200 moving average, and the 20 moving average is being used as resistance in this occasion. And you can see that the price actually got stopped by the 20 moving average and came back down. That's the reason why we use the 20 moving average as an entry, to make sure that we don't fall victim to this. Because imagine if I didn't have these other support levels here, the 50 and the 20, the 50 and the 200, and even this trend line. Maybe all that stuff wasn't there and I just jumped in without the 20 moving average getting crossed and the price rejected and dropped all the way down. I would have lost all my money. But in this particular case, I was confident that the support level was strong enough to hold it, even if I got rejected by this 20 moving average, right? I just know that I'm gonna hold it for a while. So now you got the rejection, and then you got the recovery. And then finally, price tried to cross it again, right? And it didn't, came back down again, but it's still above our trend line. It's still above the 200 moving average. We're not too much worried about it. All right, now it got a little scary because the price actually broke the trend line for the first time since it was established back here in March. That could be scary. And in this particular instance, some of us would like to turn around our position and go bearish in this occasion, because now you got the price below the 200 moving average, below the 20 moving average after it rejected, and it broke your trend line. Those all could work as triggers for you to go short on Amazon. But I'm still keeping my bullish outlook on it. I'm still looking at the chart pattern. I'm still looking at the way the price is moving. And I'm still considering the fact that after the day of bearish movement, it actually worked its way back up above the trend line, and it kind of got above this 200 moving average as well. So it kind of looks like it doesn't want to go any lower than where it did. And you can see here that you got one day of a doji, and boom, it broke all the way up above all the moving averages except the 50, tested the 50, and then the next day I'm in profit. All right, and then we're going from there. We're going from there. All right, broke out of the pattern, hit almost up to the previous high. All right, I'm in overbought territory. Boom, I'm exited the position. I got my 7.72% gain, and I'm out of there. All right. So that was an example of how you use everything from top to bottom. Okay, you can rewind this as many times as you need to get full clarity on that whole process. All right, so now next you want to maybe start looking at stock screeners. So stock screeners is something that I also use to help me pull out all the stocks that meet my criteria, right? So we looking at the stock screeners. Yahoo Finance has a good amount of stock screeners already ready for you here, right? So you have Morningstar 5-star stocks. You got most shorted stocks, undervalued growth stocks, growth tech stocks, daily gainers, daily losers, most active stocks, undervalued large cap, aggressive small cap, top mutual funds, portfolio anchors. You feel me? All these different stocks are here. All these screeners are here for you on Yahoo Finance that can pull out some of the criteria you may be looking for in this particular on your particular trading journey, right? So that's a good key for you to use. And then we have upgrades and downgrades. Daily upgrades and downgrades are coming at you from all kinds of different platforms, but MarketWatch is a good one for you to check out. So if you go to the marketwatch.com, you can look up the upgrades and downgrades, and you can see that every single day there's a good amount of upgrades and downgrades, and you can see what happens with each individual stock as they get upgraded or downgraded, right? So let's look at something that we might all kind of know about, Zoom. All right, so today Zoom got a maintain from UBS. A maintain basically means I'm not changing my stance on Zoom. If my previous stance was bearish, I'm keeping my bearish stance. If my previous stance was bullish, I'm keeping it. I'm maintaining it. So that might not necessarily have any effect on the stock price that day, or it might reiterate the fact that I believe that the stock price is bullish. And if you're asking me my opinion on it, an update on it today, I'm gonna tell you that I'm still bullish on it. And that right there might be enough for the stock to turn around and actually go bullish. So let's look at it and see what happened today. Zoom Communications was a bullish day. It didn't really move too much compared to the previous days, but oh, I'm sorry, it's actually a bearish day. So look, I was looking at this candle. Today's candle is here. So boom, it actually dropped off the face of the earth. Why? Because there's a catalyst. The catalyst is the earnings call. The earnings call sometimes has a negative reaction, even though the pot is a positive outcome. This can happen, all right, for multiple reasons. But as you can see here, you not only have a huge drop in price for the day, you also have a chart pattern, right? And this is the reason why the chart pattern cheat sheet course is going to be very, very important for you to tap into. If I draw a line here, down here, down here, and down here, that right there is a chart pattern. What pattern is this? This pattern would be a double top. So you have a top here and a top here, and they're both kind of in the same price range. This sequence and price movement right here is called a double top. That is a chart pattern. The key to figuring out how to respond to these chart patterns is catching them before the pattern is finished forming, right? So you essentially want to catch this pattern right around here, right? So when you see the price movement going and it looks like a double top is forming, it could do one or two things. One, it could go up and go bullish all the way up, which is what we hope. But in order to protect ourselves, we always have our first target on a long position is always going to be the previous high. If you trade it up to the previous high, this will kind of protect you from getting trapped in the middle of a double top. So now, if we go to the next day, you can see that a huge bearish day. That would basically give you confluence on your bearish outlook looking at this particular chart pattern. You thought it was a double top, and then you got a day where it's completely bearish with a little bit of gap down in price. Now your bullish or bearish outlook on this particular company or price movement has been confirmed, and now you look like you might be in the middle of a double top. And then we continue to move forward. For sure, you're in the double top, right? Now you got a price sequence where it looks like the price might be recovering. When you're dealing with these chart patterns, wherever the chart pattern starts is where it should probably finish. It's the double top started back here. So if this is a true double top, then it's probably gonna come all the way back down to where it started at. And just for confirmation, you see, boom, it actually ended right where it started to complete this full chart pattern of a double top. So if you were a short position, you got into a short position and you saw a double top, that would be your first sign to get into a short position. And obviously we have, as always, the moving averages letting us know that we're in a bearish trend. The price has crossed over all of the moving averages, the 200, the 50, and the 20, right? So you for sure know. And then it looks like the 50 moving average is trying to work its way back below the 200 moving average as well, right? So then you have a catalyst with the earnings call, and that's something that we definitely tap into when we're dealing with the options trading. If you're interested in options trading, tap into the options trading course. And that's a more advanced strategy for individuals who want to make a larger amount of money at a quicker pace. You can also lose a large amount of money at a quicker pace as well. But with the strategies that we use, you end up winning more than you lose. So that right there is what we're looking at for Zoom. All right, so now we're going back to the upgrade downgrade. So that maintain might have been non-effective today, right? Especially if there was a bullish outlook previously for UBS. Let's see if we can find something that has a upgrade and see if the price actually went up because of it. I see a lot of, okay, so here's an upgrade. Barclays upgrade on GoodRx Holdings. GDRX, let's look that up. GDRX. All right, so GDRX, bullish day. All right, just to make sure, okay, yeah, bullish day. You see that? A bullish day today. All right, now maybe that's not enough for you to make a huge amount of money, but that could be what you need to keep you in your position because maybe you got in back here. when the price crossed over the 20 moving average. Maybe you got in here when the price crossed the 50 and you're trying to figure out if you want to stay in because price has been moving sideways. Then all of a sudden you get an upgrade from a very reputable company saying that I believe this company is going to be bullish. And then you got a bullish day. That right there might be just what you needed to get a little bit more profit for you to close your position in a good spot. So that's how you would use those upgrades and downgrades, right? And then also earnings calls. So we talked about earnings calls. And earnings calls will be very, very significant, especially for those of y'all who are interested in options trading. You should definitely check out this Twitter page, which is very resourceful. So Earnings Whispers, all right, Earnings Whispers Twitter page actually gives you updates every single week on the earnings ahead, the most anticipated earnings ahead, not all of them. So you see this right here, this type of calendar spreadsheet here comes out every single week. They usually release that on like a Friday or Saturday evening, and you'll get that information and you'll be able to see what's coming up for each individual company. Understand that earnings calls happen. This is a catalyst that could potentially move the stock one way or another dramatically. You saw what just happened with Zoom. Zoom had their earnings call yesterday after the market closed. And then today, the price actually responded by dropping and gapping down a huge amount because of the earnings call or what the investors and traders might have been looking at as far as the results of that earnings call. All right. So the earnings call happens every single quarter. Every company, every publicly traded company on the stock market has an earnings call that happens every single quarter. The reasons why they do this is because the individual investors that we are, we don't have access to the people who are inside of the company. We can't call them up and ask them what's going on. All we can do is work with the information that they're giving us on a day-to-day basis. And they're not going to update us on a day-to-day basis because they're more so focused on dealing with the business and making sure you keep your money there. But every quarter, they have to update us on what's going on. So if you're having an earnings call this quarter, the results from this earnings call will be all the data that we collected from the last quarter. Are we profitable or not? How is our earnings doing, right? So do we have more earnings this quarter than we did last quarter or the quarter previous to that? If not, how much in the negative are we? If so, how much in the positive are we? And this right there would be the determining factor if people decide to keep their money in that company or take their money out of that company, or new people who are interested in that company, will they put their money into that company moving forward or not? All that information will be released on the earnings day. You'll have earnings calls before the market opens at 9:30 a.m. Eastern time and after the market closes at 4 p.m. Eastern time. Within those two time frames, you'll see very dramatic movements with some of these stocks off of the information that you get from the earnings call. All right. So mergers and acquisitions, very important because a lot of companies like to cheat by keeping the value in their company high by merging and acquiring other assets or other companies. So let's say Amazon, for instance. Amazon, we're good with our fulfillment business. We can send out packages in 24 hours now. We've been doing everything we needed to make sure that we are integrating the system that's necessary for us to keep this type of momentum in this company, bring these buyers here and keep them here, and make sure that they rely on us and us only to deliver their products from our website. That's done. We got that. That's on autopilot. Let's keep it moving. Now, the forecasts say that the stock price is going to be somewhere up in the $4,000 range. Why? The reason why may be because they've hearing some noise about Jeff Bezos or whoever's running the company at this particular point looking to acquire another wing to add to the Amazon umbrella, right? Maybe we're looking at acquiring a company that deals with groceries. Instead of us focusing on books and clothes and household materials and all these other things that we're used to selling, we might want to look into the grocery space. All right. So in that period of time, we have to come to the table and decide what is what kind of move is going to be valuable for us as a company moving forward if we want to jump into this grocery space? What can we afford to purchase at this point? Let's look at Whole Foods, right? So how much money is it going to take for us to acquire Whole Foods? Well, since we don't pay any dividends to our investors, we're still in the growth stage. All of the profits that we've taken in from the previous quarter, we're going to announce to our investors that we're looking to acquire a grocery store chain like Whole Foods and incorporate that into our company so that we can start delivering groceries now with the other products that we are delivering on our platform. That right there is an acquisition. So the Amazon company has acquired Whole Foods, purchased all of their real estate and all of their assets within the company, and now we're together. You feel me? So that right there would be an acquisition. An example of a merger would be, let's say, for instance, we had a situation where two platforms like two television channels maybe, right? That would be an example. I can't really think of anything off the top of my head. Let's just say, for instance, TNT wanted to merge with BET. That'll probably never happen. But let's just say, for instance, TNT wanted to merge with BET. They're looking at the similarities between the audiences and they see that it'll be valuable for them to work together. Instead of TNT being a bigger company, acquire a company like BET, which they're probably even owned by the same holding company. But let's just use that as an example. If TNT is a bigger company than BET, in most cases, TNT would try to acquire BET, right? But let's just say, for instance, the owners of BET don't want to sell it, but maybe we could partner up and merge our assets together and become one, right? So in this case, BET and TNT would merge together and form a corporation, TNT BET, and they are all together, all the assets are merged, all the resources are merged, all their staff is merged, and we just have different sections and different departments inside of the company that we have separated to where we can operate everything smoothly. But for the most part, they're merged together and their two companies became one under one umbrella, right? That would be a merger. So news like that comes out often, right? You can look at websites like Seek and Alpha. Let's look at M&A. All right. So M&A. All right, so you will pull up Seek Alpha, a company or a website like seekandalpha.com, and there's a section in there where you could look at M&A, which is mergers and acquisitions, and you can get updates to let you know every day when a new merger or a new acquisition is happening. And that right there might be something that would jolt the price up on any given day. All right, that would be a catalyst for you to find an easy position to jump into, especially if you know about it ahead of time, right? Product reveals. So Apple, for instance, always has product reveals. They always have points in time where they're revealing a new iPhone or the new MacBook or whatever, new iPad. They have product reveals. Every time there's a product reveal for Apple, coincidentally, the stock price usually goes up, especially if the public sees that the product that they're revealing is significant enough for people to want to jump into. All right. Normally with Apple, they do this thing where they have a product reveal getting closer to Christmas, where they drop the new iPhone, right? Right in time for you to go and buy new iPhones, right in time for your old iPhone to start glitching on you, for you to feel like you need to upgrade, right? It all happens by coincidence. Maybe it's not a coincidence. Maybe it's something that they have already integrated into their platform. Who knows? But either way, when they have a product reveal for a new product, you're on alert and you can see it on the chart. You can see it on the price movement of the actual stock to see like, okay, people feel like the company is actually going to earn more money by releasing this new product. And once we see the value of this new product, that might be enough for us to jump into the Apple stock and start to trade it for profit. All right. So those are different things. Also, tracking investor sentiment. So what we do with the VIP meetings and the VIP membership is every single Sunday, 7 p.m. Eastern time, we meet on a Zoom call and we go over the week ahead. And that right there will keep you in tune with the market, because most of the time, most of you guys who are taking this course right now, 9 times out of 10, the people who are you're friends with, the people you interact with on a day-to-day basis, they're not going to keep you up to date with what's going on with the market. You need to have a group of people who you are communicating with daily, who are going to keep you in the market, hold you accountable, and make sure that you are aware of what's going on at all times. I post news in the Discord. I post trades in the Discord. I post playlists in the Discord, as do the other members as well, right? And on a Sunday, we all come together in a fellowship style situation where we all communicating with each other, live Q&A, and we go over the week ahead to make sure that we all are aware of what might happen or what is going to happen when it pertains to the market and the movements. All right. Streaming news, CNBC, Yahoo Finance, Bloomberg. These channels are something that you should keep on your TV at all times, especially if you're one of these people who want to utilize your free time during the day to look and examine the market when the market is open. You want to have a show like a CNBC playing in the background, so that way you could kind of pick up on some of the things that they're talking about. They're honestly, they're going to give you some opportunities just by watching the show. A lot of times I get a lot of my trades and my entries off of what they're talking about on CNBC. I might have already been looking at Tesla. I wasn't ready for an entry. I'm looking at CNBC and they just break out some news about Elon Musk, and it's a good news. And because of that, I'm not the only one watching CNBC. You're not the only one watching CNBC. There's thousands and thousands of other people that are watching CNBC who got their brokerage accounts open, who are ready to make a move based on what they're talking about. So if I'm ready for an entry, you can assume that other people are as well, especially if we're all using the same indicators, the same technical analysis, and the same chart patterns and setups and all that. Add CNBC News on top of that, and you might be in for a ride just simply based off of them. Sometimes they have interviews. The CEOs might come on CNBC and just talk, and it's all good news. That right there could push the price up for a period of time throughout the day and could give you a potential entry. So keep that in mind. Don't always just look at entertainment and stuff like that. We're in the market. We are trading, we are investing. You have to think like an investor at all times now. You don't have time to be entertaining yourself with all this other news that's not going to actually make you any money or make you a better trader. At this particular point, you need to be tapped in 100%. Tune in to CNBC, tune in to Yahoo Finance, tune in to Bloomberg, go to bstworldnews.com and look at all the news that you can possibly take in throughout the day to help you get a good gauge on what the investor sentiment is, to help you get into an entry at the right time. All right. So then you also want to look at the economic calendars. This is something that we go over every single Sunday. The economic calendars are going to help you see what's coming up the week ahead. So sometimes we'll have speeches from the Federal Reserve Chairman. Sometimes we'll have releases on CPI data, Consumer Price Index, which is basically inflation. Any update on that will have an effect on the market. We'll have OPEC meetings with the OPEC. The OPEC is basically a group of people who are in control of the production of oil. Those meetings will have an effect on the oil market, specifically the energy sector. House prices, new constructions, unemployment data, all these different releases that come out throughout the week will be listed on the economic calendars. Definitely tap into those. They have those available on marketwatch.com. And we tap into that every single Sunday. All right. Monitoring the VIX. The VIX is the volatility index. All right. So you could pull the VIX up on your chart and just put that on your watch list just so you know where it's at. All right. The VIX basically gives you a gauge on the investor sentiment as well. When the VIX is green, that's not very good for the market. That means the market's probably selling off that day. All right. When the VIX is red, it could be very good for the market. It means the market is usually green for the day. So the VIX is actually inverse of what the market could be. All right. And this is the VIX for the S&P 500 index. So if the VIX is green, then the S&P 500 is probably red for the day. Let's pull it up and see what it actually is. And for this, I'm going to use SPY, which is an ETF trust that tracks the S&P 500. So as you can see, I pulled up the SPY, and it is the S&P 500, and today was red. All right, so the VIX was green, S&P 500 was red. All right, so now there you go. That's the correlation between those two. All right, so let's get into some philosophy, right? Stan Weinstein, right? He wrote a book back in the 80s. All right, The Secret to Profiting in Bull and Bear Markets. That book is like a Bible for technical traders. A lot of technical traders don't even use it, but I use it and I like it. And I'm going to break down a lot of the concepts in that book here in this class. So the first rule: never buy or sell a stock without checking the chart. That's off the top. Never. I know some of you guys, especially some of my VIP members, they send a message like, hey, check this out for me. I'm ready to jump in. What are you doing? Are you driving right now? If you're driving right now, don't even think about trying to buy into nothing. If you can't sit down and pull up a chart, and you got apps, the TradingView app, you can download that onto your phone, no problem. If you can pull it up and you can see if it's time for you to buy in, then do it. If you cannot get to a chart and you can't pull it up to check first, you don't need to be trading anything. That's the first rule. Rule number 2, never buy a stock when good news comes out, especially if a stock shows a significant advance prior to the news release. So just because you heard good news doesn't mean that's all you need to know for you to jump into a stock. That's what very inexperienced retail traders do. They look at the news, they pull up Robinhood, and they see the news. Okay, boom, let me go ahead and buy it. They look at the earnings call and they see that the good earnings call, and they go, okay, let me go ahead and buy it. That's not enough for you to just jump into a stock, especially if there was already bullish movement before the news release, right? Because sometimes what you'll see is bullish movement, 4 or 5 days in a row. Then good news comes out. You might have one more day of bullish movement, but you bought on that good news. Didn't even take into consideration the previous 4 days of bullish movement. And then the next day, it just drops completely off the face of the earth. Why did it do that? Because the smart investors got in way back on day one. The inexperienced investors got in on day 5 with the good news. But I don't care if you got in late or not. I'm just ready to sell because now that good news just gave me a little bit more than what I wanted. But I already made my profit because I got in on day 1. Now we're on day 5, I'm ready to sell. I don't care what you got going on. I sell, you lose money, and I'm moving on to the next position, all right? Number 3, never buy a stock because it appears cheap after getting smashed. When it sells off further, you'll find that cheap can become far more cheaper. This is the reason why I said people talking about buy the dip. Don't buy the dip. Don't buy the dip because you never know when the dip is actually finished dipping. All right. So you might be looking at the stock price dropping and you're like, okay, now is the perfect time for me to buy it. They said buy the dip. Let me go ahead and get it. You go ahead and buy it, and then the price continues to drop down. Now what do? Sell at a loss, right? So what I suggest is for you to buy on the bounce. When the dip happens and the price actually gets to a point to where it hit a support level and then it starts to trend up, now you start to look for a potential entry for a long position, all right? Same thing with the RSI that we talked about, the relative strength index getting below the 30% level. A lot of people think that that's the reason why you should be jumping in for an entry to go long, because when it's below 30, it can't get no lower. No, that's not true. It can actually get way lower than that. All right, so just be careful. Number 4, never buy a stock that is in a downtrend on the chart. That's obvious, all right, but a lot of people do it, and you know, they feel like they're buying the dip when all actuality, they're actually buying into a downward trend, and you just literally giving your money away to the market. Number 5, never hold a stock that is in a downtrend, no matter how low the PE ratio is. Many weeks later, and several points lower, you'll find out why the stock was going down. So PE ratio is one of those things that we look at when we're talking about getting into a long-term position. Price to earnings ratio, basically the relationship between the price and the earnings of the actual company. This is the reason why earnings calls are very important. We need to see if the current price of the stock is makes sense to the actual earnings of the company, right? And the correlation between the two. There is an equation that you have to look at, but you don't necessarily have to memorize the equation or nothing. They actually do this for you. So if you go to Yahoo Finance, you can pretty much look up any company in here and look, and the PE ratio is going to be here for you. So if we look up Amazon, you can see the Amazon PE ratio is right here, 60-47, right? That might be a little bit high, you know what I'm saying? So, you know, a good PE ratio should be really like under 50. You know, sometimes I like the 20s, the 20s is like a good range to be in. 60 is pretty high, right? So, but that's okay because this is a growth stock and you can't really, you know, gauge growth stocks like that. Value stock though, if you're looking at a value stock and they have a PE ratio of 60, might be a little bit too high, all right? But just for the sake of this description and these rules, let's say for instance, you are in a downtrend and you're thinking about, I want to buy the dip and the PE ratio is super low and you're like, dang, that's a good price for this value stock to have a PE ratio this low and it's on a downtrend. It to me looks like it's dipping. Let me go ahead and put my money in now because now I think I'm getting a deal, right? And then 2 weeks later, you find out that the price where you bought it at was we was just getting started. We selling this all the way down. And now you're stuck in the middle of that just because you looked at the PE ratio. That's not enough for you to jump into a stock. Rule number 6, always be consistent. If you find that you are sometimes buying and sometimes selling in practically identical situations, then there is something terribly wrong with your discipline, right? So you need to make sure that you buy when all of the parameters are adding up for you to buy. And then for all the parameters adding up for you to sell, you sell. You can't be selling and buying when both of those scenarios are the same. If that happens to you multiple times, you need to take a step back and look at your discipline because now it just seems like you're just jumping into stocks off of pure, your own pure judgment and not really looking at the technicals. All right. So that now we're getting into the stages of the market, right? So any stock has to be 1 in 4 market stages. The trick is to be able to identify each one, right? So there's 4 stages of the market, okay? There's a basing area or consolidation buildup. We call that stage 1. Stage 2 is the advancing stage when the stock actually breaks out and goes into an uptrend, right? Stage 3 is the top area or peak consolidation when the stock actually stops going up and starts to move sideways and slow down a little bit. And then stage 4 is the declining stage where it's pulling back in a downtrend or a correction or a sale when the stock price is actually dropping, right? So those are the 4 stages, stage 1, stage 2, stage 3, stage 4. You need to be able to locate this sequence on every single chart that you're trying to trade. If you pull up a stock and you look at the chart and you can't see this movement, stage 1, stage 2, stage 3, stage 4, if you can't see that on the chart, then you probably shouldn't trade that particular stock at all. You need to see this sequence to make it easy for you to swing trade successfully, okay? In this sequence with the book, he used the 30-week moving average. With us, we're gonna use the 20-day moving average, and sometimes we even use the 50-day moving average, all right? So just to give you more examples, terms that you must know, we already went over this, resistance and support, breakdown, pullback, downtrend, support area, support zone, resistance zone, consolidation zone, breakouts, uptrends, trend lines. We already went through all this stuff. You guys should pretty much know what that means. When to buy, check the 4 confirmations. So 4 confirmations to let you know when it's time for you to buy a particular stock. 1 is when the stock is actually consolidating or moving sideways, when it actually breaks out of consolidation and crosses over a moving average. Those 2 confirmations right there is like a good entry. Another 3rd confirmation would be relative strength, the RSI, when the price actually, or when the RSI trigger goes above the 50% level, that would be considered a time for you to enter. And then the volume, we didn't really talk too much about volume, but volume bars on the chart, and I'll pull that up in a second so you can see there's actually a moving average on the volume. When the volume bar crosses over a moving average, that's kind of like a trigger for you to jump in as well. So 4, really 5 confirmations to let you know when it's time for you to jump into a particular stock for a long position. Ideal buy for an investor is when the stock price is finishing up on a stage 4 decline, getting into a stage 1 consolidation, breaking out into a stage 2. Right at that breakout, boom, that would be a great entry for an investor. For a trader, you don't necessarily have to always wait for stage 1 breakouts or stage 2 breakouts. You can get into a stage 2 breakout or stage 3 breakout if it's in the middle of an upward trend, right? So let me pull up an example for you here, and we can go right back to Facebook. If we look at Facebook, you can see that Facebook actually broke out here. So you can look back here at February 2021. This right here is a stage 1 right here. Stage 1 consolidation right here. Price is moving sideways and is right under the 50 and 20 moving average. Crossed over both of them, broke out of the consolidation zone. Now we're in a stage 2. That would be a great entry for an investor. If I was an investor and I jumped into Facebook at this stage 2 breakout, I would have been in position to make a large amount of money if I was still inside of this Facebook trade, right? As a trader, I would be looking to get in here as well, but maybe I missed this breakout. How would I know when it's not time for me to jump in again, right? So now you got the 20 moving average, the 50 and the 200. Clearly it's above the 200. Clearly it's above both of the 50 and the 20, right? Now we're looking to see what stage the market is in up here. We're at a peak. It's moving sideways. That's stage 3. What happens after stage 3? Stage 4 decline. It declines all the way down, crosses back below the 20 moving average. Now I'm using the 20 moving average as an entry, right? If I were to enter at a 20-day moving average on a bullish trend, that would be a trader's entry here. Boom, I enter here, get all the way up to this point, and now we're back into a stage 3. I might exit here, boom, stage 4 decline. Right below the 20 moving average again, crossed over, boom, I'm back in here again. All right, a little bit of sideways movement, but then I'm up. All right, I'm up. Sideways movement, sideways movement, sideways movement. Tested the 20 moving average, boom, went up again. Sideways movement. All right, stage 3, stage 4 decline, right back below the 20 moving average. So if you use the 20-day moving average on an uptrend, that can help you get in and get out of trades on an uptrend for a trader. For an investor, you probably would have got in back here when the 50 moving average got crossed, and you probably wouldn't have got out of the trade until the 50 moving average got crossed back over again. Let's say, for instance, you got in when the 50 crossed over here for a stage 2 breakout. If you got in here, at no point as of yet did the price breach the 50-day moving average. It's still above the 50-day. So if you would have got into Facebook back then when it crossed on that stage 2 breakout, using the chart pattern, using the chart, the stages of the market that I just broke down, let me just take this 20-day moving average off so you guys can see clearly what I'm talking about. If you would have got into Facebook on that 50-day cross, you'd still be in Facebook right now. You would have made 43.81% return on your money, and you would have been holding that trade for about 175 days now. Through all the ups and downs, all the consolidation, all the red days with huge sell-offs and uncertain markets and people on CNBC talking about we're about to have a crash again and all that, you would have been sitting with a 43.81% profit. And you wouldn't have been, you were not even looking at getting out of this trade until price crosses back below the 50 moving average again. Goes into a stage 3 and then into a stage 4 decline below the 50-day moving average. Now you're looking to exit. That will make your trading journey a whole lot easier by simply using these stages of the market. All right. So when do you sell? Stage 4 decline. If we're using the 50-day moving average in this case, we want to wait until the price consolidates for a few days or whatever, and then crosses below the 50-day moving average. And that's at that point is when we exit the trade or look to get a short position and short it on the way down and get money on the stage 4 decline. All right. Month-to-month patterns, you'll see that these patterns kind of stay with the test of time. Summertime, you see May, June, very low volume as far as trading is concerned. This is the Dow. So this is information that they've collected since the 80s, 87 to 83. What is that? 1897 to 1983. This is the market year, right? So the percentage of time you see very, very high volume in December and January relative to the summertime in May and June, right? And then September, October. So August, huge bullish movement in August, present day, same thing, right? Now September, we're going to see what happens. Are we going to be in a decline in September? Maybe, maybe not. October, a little bit more volume. November, starting to get closer to the holidays. December, all the consumers are starting to buy. You know, consumer cyclicals, consumer discretionary. A lot of the tech companies, Apple, people buying iPhones, all this stuff. It makes sense. People go shopping. It makes sense. You know, people who have in the investor community, the market makers, the summers are over. They're back into the office. They're back in and getting active, and the volume is coming back in. The winter time is when huge returns are being gained, right? Historically, that's usually what happens. And then we go to the 2000s here, and you can see that pretty much the same thing, right? So you got low months in August and September, all right? October starting to pick up, November, December, booming. January, booming. Then February, a little bit of a break. March, picking up, April picking up. This year, for the trading group that I'm in right now, May, June, very, very profitable. Even April, March, very, very profitable. Then July happened, and then it started to slow down a little bit. August, we're starting to pick it up a little bit in the end of August, right? So you can see the correlation from month to month. Even with COVID going on and all that stuff, it still kind of keeps the same pattern for the most part. Day-to-day patterns. Monday, Tuesday, Wednesday, Thursday, Friday. So usually on Fridays, you have a lot of volume on Fridays, a lot of buying, a lot of selling, a lot of people cashing in. Most day-to-day people who trade, retail traders, you know, they make up a good amount of volume in the market. They get their checks on Friday. For people who are interested in investing, they put a lot of their money into the market at that particular time. For people who are investing in their 401ks or IRAs, a lot of those contributions go in when the check gets cut. And then obviously there's a lot of market movement just based on Fridays in general, people wanting to close out their positions for the weekend and make a lot of movements that way. Monday, a lot of volume, but the volume might be in the opposite direction depending on what's going on with the market. Mondays could be very, very telling for what the week might hold, but it also could be very, very volatile for people who are trying to jump into positions or even exit positions on Mondays. And then you got Tuesdays a little bit more stable. Wednesdays start to pick up a little bit. Thursdays a little stable, and then Fridays, you know, we normally have very profitable Fridays in my group. All right. Keep a trading journal. Document your losses. Winning teaches you nothing. These are my rules. I'm telling you from experience. You don't really learn too much off of winning. Only the fact that you can accumulate a lot of data to see what you were most successful with, and then you can use that successful data to move forward. Yeah, but for the most part, if I'm on a winning streak, I'm really not learning too much. I'm just coasting for the most part. And usually what happens is when you're in the middle of a winning streak, that's when you start picking up bad habits. All right, I was in sports. I played professional basketball for 10 years. Trust me, when you're in a winning streak, that's when the coaches get nervous, because the coaches know that if the team continues to win at this pace, it makes his job less valuable, because now players start to feel like they don't need the coach. We just doing what we do. I'm out here winning. We busting these teams behinds, and we coasting right now. What do you need to coach us on at this point? We know everything. We winning, right? There's nothing for you to tweak. There's nothing for you to fix. There's nothing for us to examine. Let's just continue to win. Practices get easier, a lot more joking and laughing, people treating you better. All these things happen in sports. Well, in the market, it's the same thing. You're in it by yourself, right? So if you win 1, 2, 3, 4, 5, 6, 7, 8, 10 trades in a row, you're not about to go back and look at your mistakes. What mistakes? What do I need to look at? I'm winning. I'm making money, right? So because you're not continuing to study, continuing to educate, and continuing to stay disciplined, slippage starts to happen. And every little bit of slippage goes unnoticed because you end up with a win. But every single small slippage that goes unnoticed, it gets built up on, built it up on, built it up on, and to the point to where it can't be unnoticed anymore. And you, boom, hit a wall, and then you lost 3 or 4 trades in a row, and you don't know how or why. Though that losing streak that you might be in right now actually started in the middle of your winning streak, because the bad habits that you picked up when you were winning, you didn't correct them when you could have. So that's why I say winning teaches you nothing. So don't get excited when you win, all right? You need to have the same mentality when you win as when you lose. Stay at an even kill, because that's going to keep you honest and disciplined. And trust me, this market will humble you every single time. Don't go outside and say, yo, I'm best trader in the world. I won 10 trades in a row. Tell me who else out here won 10 trades in a row. Me, that's who. Okay. The next day, the market is going to spank you, trust me. And you don't want to get to that point. So to avoid that, keep a trading journal. Notate everything that you've been doing up until that point. Entries, exits, losses, wins. Do your chart patterns, do your candlestick patterns, measure your support and resistance, make sure you're mining your trend lines, make sure you're mining your moving averages, your RSIs, your MACDs, volumes, all the indicators that you decide to use. Make sure you're tapping into all of those. Document your losses, because that's where you're going to learn, right? So if you take an L, don't just take the L and move on. Examine why. So that way you could potentially protect yourself the next time to avoid that loss. That's how you get better, right? And then the examples that I gave you, Facebook, Apple, Amazon, Netflix, Google, these are easy trades for you to start out with that have high volume. Everybody knows them. Everybody's trading them. The prices might be pretty high at this particular point, but there's platforms that you can use that will allow you to buy fractional shares if you can't afford to buy one whole share of Facebook, for instance. You can go to m1finance.com and buy fractional shares and still get the gains that you want to get, but it just might not be as much if you were able to buy the whole share, all right? And we actually have an attachment available for you in this course where you have all of your resources available, and M1 Finance is one of the resources that I provide for you, okay? So use fundamental and economic news for investor sentiment. Tap into the VIP Sunday meetings to keep you informed. And the VIP groups and trading communities always keep you motivated and keep you tapping into the market. Take advantage of all of that. That's all here for you, and that's all gonna help you continue to win, all right? Hopefully you guys learned everything you need to know. And we're getting up out of here, all right? Peace. Have a good evening.